If you've ever invested into gold, or you've watched the price move up or down and had no idea why, then this video is probably going to give you the clearest understanding you've ever had on the price of gold. Because in the next few minutes, I'm going to show you the exact framework that took one of my students, Rakib, from being down £18,000 trying to invest into gold to making $48,000 in a single month. Because here's what makes this so powerful. It all comes down to one thing. One simple driver that really moves the price of gold pretty much all of the time. And it's not the news, it's not wars, it's not predictions. It's one piece of macro data you can actually track daily, step by step, simply explained. So if you stay until the end, I'm going to give you a free macro training where I break down the full framework professional investors use to read the gold markets with clarity. So let's get into it. Now, over the years, I've personally educated thousands of investors through my private investment communities. And I've spent thousands of hours studying macroeconomics, capital flows, and the data professional investors use to make their decisions. And one of the most consistent things that I see is capable, intelligent investors losing money in gold. And it's not because they're not smart. It's simply because no one ever showed them what actually drives the price of the precious metal. All right. And Rakib was literally one of those investors. He came to me because he had just lost £18,000 trying to invest in gold. And he was doing what everyone else does. He was watching the price. He kept reading the news, trying to time the markets based on the headlines or the price movements. And every time he felt confident enough to take a position, the market then just moved against him. Okay, and the moment I showed him this one driver that you're going to learn in this video that actually drives the value of gold, everything literally changed overnight, almost. He stopped watching the price and he started watching one piece of macro data. And for the first time, he had a clear, rules-based reason for every decision. And within a month of applying this framework, he made £48,000. And I'm going to show you the testimonial at the end of this video. So you've been a member of the community for quite a while now, over a year, you said, right?
Over a year now, yeah.
Okay, and how are you finding it so far?
Before I actually even joined the group, I was literally going through like financial difficulty. That's it. I was like, oh my God, that's it, I'm done. I don't know where to turn and where to go. But obviously I found you through like some friends and, like Instagram and stuff like that. And then for a year, but honestly, it's just been life-changing, the whole journey itself. So before I joined, I was investing like £300, £500, but I was losing it all. So I did lose over £18,000 with myself.
What was the biggest significant difference you realized when you joined my community?
It was just the knowledge of where the markets are moving and, what's causing the markets to move. Helps a lot with being able to put that trade on and knowing when to put that trade on as well.
I'm glad that you've been able to find some consistency. So how much exactly have you made in total since you've been inside the community?
So I invested into gold at the time when obviously you sent out the signal. I made 30k alone from that trade.
30,000 from £300.
Yeah. So I took out in total, it was 48,000.
Okay. From £300.
From £300 to 48,000. So I took out 48,000.
Well, I'm happy for you, man. If there's anything you can say to other people who are thinking about learning investing and thinking about getting into the education, would you say anything that would encourage them?
Honestly, I was in that place where I was really scared at first. And, I would say, honestly, just forget about everything and just invest.
Okay, and that was not from luck. It was from understanding the single force that drives the price of gold. So here's exactly what we're going to cover. First, I'll explain to you why gold is fundamentally different from every other investment and why that difference is actually the key to understanding what drives it. Secondly, I'll show you the one macro signal that drives the demand for gold, and that's real interest rates, okay, and exactly how to understand it. Thirdly, I'll break down the specific conditions that push real interest rates up and then pull them down so you know exactly what to watch for. And fourthly, I'll show you how this same framework applies to reading any financial market because all the markets are driven by the same macro forces. So by the end of this video, you're going to have the same framework that Rakib used to go from literally minus £18,000 to £48,000, one driver. Simply explained, immediately applicable for you and your investments. So with that said, let's start with what actually makes gold so different than every other investment. So guys, gold is unlike any other investment in the world. You have to remember it pays no interest, okay? It pays no dividends. So it generates no income. And this changes the game for gold compared to other assets, right? Because if I hold gold for say 10 years, you simply own the same bar of gold than you started with 10 years later. Now compare that to a government bond. Let's say I want to Let's say I want to borrow money to the US government, right? The US government's running a deficit. They raise $500 billion a year and they borrow it from investors, okay? So if I borrow money to the government, I'm guaranteed to get a fixed rate of interest every single year. Plus I get back my initial loan, the principal I've lended to the government at the end of the maturity date, right? So this creates a very important question to every investor. Why would anyone hold gold when it pays me nothing? Okay, when I can essentially borrow money to a government which pays me interest. So the answer to that simple question is what actually drives the entire gold market. So what we need to understand is the demand for gold is driven by something called the real interest rate. So let me explain exactly what that is. A real interest rate, okay, is the interest paid on a government bond minus inflation. And that's it, okay? So this is why it's so important to the price of gold, because the primary role for investors, okay, when they're looking at gold is to hedge and protect them from inflation, okay? This is literally the last resort that investors turn to protect their money from inflation if they can't get protection in government bonds, okay? So they're always asking themselves the question, we're talking about an investor here, or yourself when you're looking at gold or bonds. You're asking yourself, do I hold a bond that pays me interest? Okay. And if I hold this bond, is it going to protect me from inflation? Or you're going to ask yourself the question, if the bond does not protect me from inflation, then I need to find something else that will go up in value that will protect me from inflation. And that is when investors look at buying gold. That's the only time. Okay, yes, we can get spikes in gold if there's a breakout in a war, if there is some news that hits the headlines, but it doesn't last. It's kind of like a knee-jerk reaction. The long-term trends in gold is always driven by the real interest rate. Okay, that's always like the fundamental factor driving price. Okay, so this is what investors are always looking at. So think about it like this. If a bond pays me 5%, I borrow money to the US government over a 10-year period. It's paying me 5% interest. Happy days. If at that time, okay, inflation is projected, and this is the most important thing you need to realize, it's not about where inflation is today, because remember the markets move on expectations. So if we have a 10-year break-even inflation rate, which is basically the projection of inflation over the next 10 years, if that is at 2%, well, then I'm happy because I'm like, well, the bond's paying me 5%. Inflation's only 2%. So my real return, the real interest paid, the real rate is going to be 3%, right? So in that environment, the bond is generally growing the wealth of your money above the rate of inflation. Okay. And then you're looking at gold and you're saying, well, gold's not actually going to pay me anything, no interest. So gold doesn't look attractive in this environment. Okay. So why would I own gold when it's not paying me nothing? Okay. When the bond can pay me 3% above inflation. So it's a simple trade-off. Okay. So in this environment, the demand for gold falls. There's no demand for gold in this environment because I'm being protected by inflation, by government bonds. Okay. Now let's flip this around and look at this in reverse. If a bond is paying me 2% interest, but all of a sudden the break-even inflation rate jumps up to 4%. Now my real rate of return is now minus 2%. So all of a sudden these government bonds don't look so attractive to me anymore because inflation is expected to be 4%, but the 10-year government bond right now is only paying 2%, right? So any expectations in the inflation rate changing can have a massive impact on what happens with gold, okay? Because think about it. Now the bond is losing your money in real terms because inflation's higher than the interest you're getting paid on that bond. So suddenly holding gold now protects you from inflation. So now gold becomes far more attractive to investors than bonds, which are losing money. So demand for gold rises and the price of gold rises. Okay, so what you're seeing here is the entire mechanism. If real rates are going up, so investors are getting protected more from inflation by a higher interest rate relative to the expected rate of inflation, the demand for gold will fall. Okay, so real rates up, gold down. Now, if we have that in reverse, if for whatever reason inflation is rising at a faster rate than the interest rate paid on government bonds, now real rates are declining. And now gold is going to go up in value. This is why every time central banks raise interest rates, the price of gold collapses. And every time a central bank cuts interest rates, the price of gold surges. So let's get specific. What actually causes real rates to rise? Because remember, when real rates are rising, demand for gold is falling. Okay? So there are three conditions to watch. Firstly, rising bond yields. And just remember, the yield simply means the interest rate paid on a government bond. So when bond yields are going up, the interest paid on those bonds are increasing. And obviously, higher interest rates mean higher real rates of return for investors who are holding those bonds. So bonds become more attractive than gold. Okay, it's as simple as that. Then we have secondly, higher interest rates being driven by central banks. So you saw this classically play out in 2022, okay? The central bank, so let's look at the Federal Reserve here, was raising interest rates to fight off inflation. Okay, after COVID breakout, the war in Ukraine, we had rapid inflation all around the world. So interest rates and government bonds shot up aggressively because the central bank was raising interest rates. Okay, and when that happened, bond yields were rising across the yield curve. Okay, so which essentially means borrowing money to governments over different time maturities. Every bond started to pay higher amounts of interest. Okay, so in this environment, again, bonds became way more attractive and gold came under heavy selling pressure. So here is a perfect example of this playing out in 2022. In March 2022, the Federal Reserve started raising interest rates very aggressively to fight off the inflation that was surging around the United States. The European Central Bank raised interest rates, the Bank of England raised interest rates, and you saw the 10-year government bond interest rate jump up from 1.675%, which you can kind of see just here on the right-hand side, and interest rates shot up to around 4.32%. Very aggressive rate hikes as the central bank was trying to fight off inflation. And look what happened at the exact same time. Gold tumbled 22% as soon as the interest rate on government bonds started to shoot up. Then thirdly, falling inflation is another reason why gold will go down, because again, the real rate of interest paid on government bonds minus inflation means that the real rate is going to be getting higher for bond holders. Okay, so when inflation falls, the real rate of return on a bond goes up. Even if the yields don't move, if just the inflation numbers start to go down, it automatically means the bond yields are paying a higher rate of return. Okay, and this is why inflation expectations, which I was talking about, is so crucial, because investors are always monitoring where are we expecting inflation to go, because that's going to give them a very good idea as to what the real rate of return is they're going to earn if they're borrowing money to a government holding bonds. Okay, so this is very crucial. And this obviously, in an environment of falling inflation, will reduce the demand for for gold. My apologies. Okay, so when you see rising yields, interest rate hike expectations by a central bank, or falling inflation expectations, well, this is the environment where gold struggles. Okay, because real rates in this environment are going to be rising. Okay, and demand for gold will be falling. Now, let's look at the opposite. Okay, what causes real rates to fall in the markets? And essentially, when real rates fall, well, we know the demand for gold in that environment is going to be going up, because now investors are no longer being protected from inflation. Okay, So it's exactly the same, but it's just reversed. So falling bond yields, well, when yields drop, the interest paid on government bonds shrinks. So the real return above inflation is falling. And this is the environment where gold becomes relatively more attractive to investors. Okay, so falling bond yields. Then secondly, if central banks are cutting interest rates, okay, this is also going to stimulate the demand for gold, because when central banks are lowering interest rates, they're trying to stimulate the economy. And this is actually what causes the bond yields to go lower. So soon as central banks are slashing interest rates, the real return on bonds falls with these interest rate cuts. Okay. And that's why capital now starts to look for an alternative, because they're thinking, well, interest rates are going down, less protection from inflation on bonds. Let's look elsewhere. And this is why it's not just the gold markets, but if you look at stock markets, if you look at commodity markets like gold, every time central banks cut interest rates, you see these markets take off, because there's a huge rotation in capital coming out of the bond market and looking for an alternative to protect them from inflation. Okay. And then thirdly, rising inflation. Okay. So when inflation is going up, okay, the real rate of return on bonds is being eaten away. And remember, when central banks cut interest rates to stimulate the economy, what is that going to do? Generate inflation. Okay, that is why central banks cut interest rates. They're trying to get inflation back up to 2%. They're trying to stimulate economic growth. And investors will then look to turn to gold to protect their purchasing power, because now we're in an inflationary environment where prices are going to be going up. Okay. So you have to remember this at all times. Remember, if a bond's paying 2%, in a world where inflation is 4% in this example, well, then your money is losing value. Okay. So whenever you see falling bond yields, whenever you see interest rate cuts, okay, and these two move in tandem with each other, okay, and whenever you see inflation going higher, which is normally in this environment of lower interest rates and falling bond yields, yes, sometimes it could be commodity prices going up, it could be a war in Ukraine, it could be a war in Iran between the US and another country, but generally higher inflation is driven by central bank interest rate cuts, okay? Well, this is the environment where gold is going to thrive, okay, because real rates are falling in this environment, okay? So therefore, the demand in gold is going to be going higher. Okay, and this is exactly what I educated Rakib on. Okay, as soon as he learned this and understood what to look for and to read, instead of watching the price of gold, he was watching real interest rates. And when these conditions turned in gold's favor, which was at that time falling yields and interest rate cuts that were on the horizon, which was going to be generating inflation, he positioned himself with confidence because he knew what was coming. That was the framework that I educated him on what to look for, and it paid off big time. £50,000 in a month is incredible, and that's a real rate of return, and you're going to see the testimonial shortly. So let me bring this all together one last time. Gold pays no interest. Its biggest competition is government bonds, okay? So deciding whether you want to be in bonds or gold, again, comes down to one thing: real interest rates. The interest paid on a government bond, which is called the yield, minus inflation expectations. Remember what I say about expectations. It's not about where inflation is today, it's where inflation's going into the future. Okay? So when real rates are high and going up, okay, bonds win. Gold demand falls, and therefore the price of gold falls. Okay? When interest rates are low, negative and falling, so there's less protection from inflation, the real rate of return on bonds is going lower, gold always wins. Demand for gold rises and prices rise. And the conditions which move these real rates are very easy to track. Okay, we have to track bond yields, central bank interest rate expectations, and inflation. That's the framework, not the news, not the wars that are in the headlines, not random predictions of price where someone tells you they think they're going to go here, there, and everywhere. It's just the real interest rate. And once you understand it, you start reacting to the news headlines okay? And you start reading one signal that actually drives the precious metal. So understanding what to look for is one thing, but actually having the data is another. So when I'm coaching people and mentoring people on how to track the macroeconomic signals that drive the gold markets, we use this analysis, which is updated in real time. So it's fast, rules-based, and instant in one place for you to track the numbers. So we can see, okay, here is where current inflation is, which is important, but more importantly, what are central banks' expectations for inflation? Because remember, this is going to drive their interest rate decisions. So we track this in real time. Okay, what are the consumers' expectations for inflation? Okay, because consumer expectations for inflation are going to drive their spending. Okay, and what does spending drive? Actual inflation. So we track these numbers. What are the actual break-even inflation rates? So this is literally the market's live expectation of inflation over the next 10 years. So we can see this in real time. And once you can track these numbers, okay, you can then start to see, all right, well, where is a central bank taking interest rates right now? And at this moment in time, when I'm recording this, there's this war going on in the United States and Iran. And right now, the markets have been pricing in potential interest rate increases by the Federal Reserve. And if I show you the price of gold as we stand, you will see, no surprise, that look what's happened in 2026. The price of gold has gone down because markets have suddenly started pricing in interest rate increases. You see, this plays out in real time. It's incredible. Okay. If I showed you before the war in Iran started, at the beginning of the year, look where gold was at record highs. Soon as the war started, gold has now tumbled. How much is gold down now? Around 25%. No shock, because in January, these interest rate increases were not expected. All right. So as soon as you can get the data, you can start to build the picture. You can understand what to look for. And this is what changes the game for you as an investor. And then here, look, we can actually track in real time. What is the actual real rate of return on the actual 10-year government bond? So we can track it. Here's the last 30 days. So once you understand the macro framework, you understand what data to look at every day. You understand what to track in a certain sequence, which is what I educate people on, which is exactly what I educated Rakib on. You're then going to be like, wow, I know what to look for. I know when to buy. I know when to sell. I know when to hold. I know when to be patient. So here's like the yield curve, and you can see where government bond yields are going, which is again another really good expectation for the rate of inflation where we're going into the future. Okay, then we have other macroeconomic data prints that we monitor, which basically explains why the inflation numbers are being predicted. So this is a real 360 macro framework that you have to have, because if you don't, you're just going to be like Rakib, who was trying to invest, feeling frustrated, feeling confused, jumping from headline to headline, emotional trading, and it always ends up in you eventually just giving up. And it's not actually because you're not smart, you're not intelligent, it's because you just don't have a rules-based framework that tells you what to do in specific environments. Once you have that, everything changes. So guys, real interest rates. Now you understand what's really driving the price of gold. Okay, now the key, as I was explaining, is you need the macro framework. Okay, because the same forces I was explaining, real rates, bond yields, central bank policy, and inflation, they're driven by a broader macro framework that investors are tracking every single month. And there'll be business surveys you need to learn, consumer surveys, you need to understand the bond yields, central bank decisions, and you need to be able to put this puzzle together so you can understand where the economy of a country like the United States is going, where inflation is going, and then more importantly, then you're going to have a very clear idea. This is where interest rate expectations are going. This is where the stock market's going to be moving, bond markets, commodities like gold, and other commodities like oil. It really does build a 360 macro picture. One framework, and you have a complete overview of where all the markets are going. Okay, so first of all, watch the video testimonial of Rakib so you can see exactly what he says about how this really transformed his life. Okay. And then come over to macromarkets.co.uk, where I would like to give you a free macro training on how to break down this macro framework. Okay, so you'll learn how to read the data, what to look for every month, how to position yourself ahead of the major market moves. All right, and then hopefully I'll speak to you shortly, and hopefully I'll be investing alongside you, and I'll be helping you get the same results as Rakib. So thank you so much for watching. I hope to see you guys again soon on my channel, and take care.